All right, we have gone through a lot of standards now, like about four standards, I-16, I-40,
Yes.
uh, 523 borrowing costs. Then last one, what was the last standard? Intangible assets, 38. And today we
Intangible
are,
asset. Yes.
yes, today we are on IAS part 36, impairment of assets.
Assets.
Whatever assets you have, almost those types of assets would actually face this impairment. But now, there are some standards which are within themselves. They within themselves explain how to impair the asset, right? For example,
Yes.
inventory, you will see how to do that. There are a lot of standards which have their own way of impairing the assets, but this I-36 is special for those assets, especially those non-current assets, the standards of which do not explain how to impair the asset, right? Like I've seen under 16, you just say, okay, the carrying amount maybe using the cost model would be the cost less accumulated depreciation less accumulated impairment loss, but there is no way of obtaining that impairment loss until you resort to this standard, right? So not that we are using this, but it does not explain how to get the impairment for all scenarios, right? There are some items
Okay,
which
fine.
explain for which the standards explain how to get the impairment by themselves. So that's why
Okay.
you say you can see this objective set rules. The main aim of impairment, if you do remember now we'll start repeating what I told you before when you were doing in a 16 PTE. I told you that we try to make sure that the carrying amount at which you have held the asset in the books is not more than the recoverable amount. Because if you have the asset,
Amount.
you expect economic benefits. Those economic benefits in recoverable, it could be you either proceed using the asset, at which point you get the value in use, right? Or maybe
Yes.
you say, okay, I no longer wish to stay with this asset, so I'm going to sell it. So if you sell it, you get an amount which we would expect it to be equal to fair value, less cost to sell. When we sell an item, actually, you're going to incur some transaction cost, let's say, right? So less cost to sell. So you do compare these two. Should you proceed to use the asset to gain something, or should you sell it outright to gain something? So you take the higher value, obviously, you take the higher value, right? So that higher
Yes.
value you compare it with the carrying amount. If you find out that in your books you have an amount, let's say 80, which is let's say value news was 70, right? And fair value cost to sell was 60. Then we would have said, okay, if I want to recoup the amount, I will have to take the higher value between 70 and 60, and then I would take it to the 70. Now you look. In the books, you have recorded the asset at 80, but you can only recoup 70. So it showed that proceeding to hold 80 in the books would only show that you have overstated the assets, right? So we avoid
Yes.
overstating the assets, and that's why we say it helps to set rules to ensure that the assets of an entity are carried at no more than the recoverable amount, just like that.
Amount.
Yes. So maybe you can have the scope here, standard which it applies. The scope is what I told you that there are standards which do not explain by themselves how to get the what? The impairment. So 36 comes into play, right? Yes. So here we have inventories as two, right? But also we'll come and see this, right? Maybe as of now you can just stop looking at this one, right? Let's take another
Okay.
example. Of course, IS-19 is the employee benefit. You're saying exclude it, but actually, as of now, you're just starting. I need to give you some examples. Focus on IS-2, but also focus on IS what? IS-16. That's what we're going to deal with. But we can also focus on what? IS what?
IS 40.
IS-40. Yes, investment property. And these non-current assets held for sale. I want us to deal with these things which are directly related to non-current assets because that's our what? Our aim, right?
Okay. Okay,
Yes.
fine.
Yes. And that's why there are standards which explain by themselves how to get the what? the impairment. That's why
Impairment.
inventories would not need that, right?
Okay.
Inventories, you don't need to apply at 36 because there is a way we usually measure inventory at the law of cost and net realizable what? Realizable value. So it should have its own way of obtaining the impairment, and they would see that. This construction contract is no big deal. You'll deal with this. Right now, actually, it was changed, and it is explained by, it could also be explained by IFRS 15 and the revenue kind of, right? But also, deferred tax assets have their own way. You would see this as well. There is another called as 12 income taxes, so it has its own way of getting this, right? Right?
Okay.
Yes.
Yes, sir.
Hello?
Yes, sir. You had muted yourself.
Yes, 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 yes. Okay, so you also have these assets arising from employee benefits. So see, this is S19, as I told you, so leave it. Financial assets, there's something we call financial instruments. We can have financial assets like investment in debt or investment in equity, so we also see it, right? And
Yes,
we
sir.
have investment property. Investment property, actually, that's why I was trying to tell you before that we can apply some of the standards. Investment property has two models. You can use the cost model or fair value what? Fair value model. For cost model, I told you that the way you apply the cost model on investment property is exactly the same as for PPE, right? So investment
Yes, sir.
property and the cost model, you can use as at a fixed, right? Investment property and the cost model you can use as at a fixed, but investment property at fair value, you don't use it at a fixed. If you do remember, we said that if you use the fair value model, there is nothing to do. You even stop depreciating the asset, right? You just take the fair value at the end.
Yes.
Yeah, yes, it's simple as that. So that's why just the process of taking the fair value of an asset at the end of each year, it's like you're already impairing the asset because if the asset has dropped in value, the fair value would also be low, right? That's why now investment
Yes.
property at fair value would not need this standard to obtain the impairment. So you can derive now. In case I said the standard to which it applies, I would have said investment property and a cost model, right? I'm going to try to do the review of this scope now. So if I say investment property and
Okay.
a cost model, I would apply this, right? But also, if I
Yes.
apply IAS 16, it doesn't matter whether I'm using the cost model or the revaluation model, it applies it all, right?
Yes.
Intangible assets, I38, I38. The standard applies, doesn't
38.
care, yes, yes. But also here we're speaking of non-current assets held for sale, classified as held for sale. I told you if you classify non-current assets as held for sale, the standard called IFRS 5, it no longer becomes a non-current asset, it becomes a current asset and you stop charging depreciation. Now there is a way of getting impairment by itself, and they would also see that, right? So you also want
Yes.
to apply. So as of now, I think you should focus on these three what? Standards. Because you are starting,
Okay.
these are what you have covered. So know that you can apply this at 36 on investment properties, but only when using the cost model, right? And the I-16 for both cost
Okay.
model and the revaluation model, and for I-38 for both cost model and revaluation what? Model. That's what you need to know, right? Okay, you see the other definitions is
Okay.
nothing impairment. We know the impairment because the impairment is the difference. Is actually the difference between the carrying is the excess carrying amount is the excess of carrying amount over the recoverable amount. We have even seen it here, right? 80 of the carrying
Amount.
amount, measurement of the recoverable amount. So you can just say that, or maybe you can
Amount.
put a reduction of recoverable, simply compare recoverable and what? Carrying amount. Then you take the excess of carrying over recoverable, not just the difference. Definition of fair value, I've seen it several times now, under 16. You have seen it under 40, it's just the price received when selling an asset in an orderly transaction between market participants at the measurement what? Date. I hope you do remember when you did explain every point, right? About the date that the fair value will be
Yes.
changing, order transaction, actual transaction maybe does not involve people maybe in a cornered situation, market participants, people who know well the price, who understand well the market, people who cannot be black marketed, right?
Yes.
Yes, okay, now impairment, you can see the impairment here. As I told you, whenever you do want to compute the impairment, you need to get the recoverable what? The recoverable amount. And you can only recover the funds from your asset either by selling it or using it for some years, right? And then getting the present value of the cash flows you expect to
Yes.
get. Yes. So that's why the first option is to sell it. If you sell the asset, we say you have the fair value less cost to sell, or sometimes you can just call net realizable value. But the standard speaks of this way: fair value less cost to what? To sell. But if you decide to
So,
use it, you would get the cash flows at the end of each year, end of each year, and end of each year. You could just compute the present value of those assets, of those cash flows, right? And then you
yes.
would get a single value, which we call value in what? In use. Just like I've
In
told
use.
you about there from tax savings. Okay, now measurement of recoverable amount, like I've told you already, how do you measure it then? We know that we have this variable cost to sell as well as value in use. How do we get them now? Of course, in an exam, it would be easier because everything would be provided. We are presuming maybe you're in the company and you need to get it. Speaking of fair value
Okay.
cost to sell, it's obvious, right? Measurement maybe by a binding sale agreement. Maybe when you bought the asset, you enter the binding sale agreement. Maybe you have sold it at a certain point in time for this value, right? So it obviously result in the contract. In case that was the case, that was the situation. But it could also based on the current market
Okay.
price less cost of disposal, which is normally the case in suppose maybe no contract was entered into, there was no agreement, right? Hello?
Yes.
Yes, yes. So that's what okay, what about the cost to sell? What are the costs to sell? It's obvious. Whenever you need to sell something, you would have to make the preparations, make sure that it is in a sellable condition and actually to actually sell it. So the cost to sell are all incremental costs directly attributable to the disposal of what? Of the asset. Right. Maybe you need to even get an agent to help you locate a buyer. Maybe you need to transport the vehicle to someone. Someone has told that, okay, I'm going to buy, but bring it to my place. Right. So
Yes.
those costs will be directly attributable to the disposal of the asset. It means that they are the costs which you only incur because of the need to sell the asset. So do not count those costs which maybe you would have incurred nevertheless, even if you did not sell that, you did not sell that asset. Okay. So I think on favorless cost to
Okay.
sell, just normal words. Now, as for value news, like I told you, will result to the concept of time value of money and you determine the present value of future what? Future cash flows.
Which are
So you
cash
can say
flows.
maybe at the first year I'm going to get 10 million, the second year 10 million, the third year 10 million, but then after this 10 million of cash flows, maybe I'm going to sell my asset now. After having consumed it to the fullest, maybe I'm going to get 5 million. So you can say, oh, so at the end of the third year, I'm going to get a total of how much? So 15, right? So what you
Yes.
do, you add all your cash flows for the first year, for the second year, and for the third year, which is 15. While you do remember to discount them to their present one value. Like
Present
we
value.
said, yes, present value equals to future what?
Future
Value,
cash flow.
yes, divided by
Future value.
what?
R A
R
1 plus R
power
square
N.
N.
Yes. So yeah, let's say
Yes.
R is 10%, it could be 1 plus 10% is 1.1. So for the first year, I would say 10 over 1 point what? 0.1. For the second
1.
year, I would say, oh, wow, 10 over 1.1, but what? Well, and for the third year, I would say it's 15 over 1.1 power per 3. And then I would have my value in what?
3.
Just like, all right. Okay, so that's all. Okay, now let's go. Yes, that's why you can see the value news is determined by estimating the future what? Cash inflows and
Cash
outflows, like
flow.
you have seen this 10, 10, and 15, to be derived from the use of an asset and the ultimate disposal. The ultimate disposal is these five, right? And applying the
Yes.
suitable discount rate to this cash flow. What matters now is the cash flows. Look at this now. These are the important points. The cash flows relating to financing activities or income taxes should not be what? Included. It might happen that they provide you with maybe the cash flows after tax. We don't use cash flows after what? After tax. We need to get them before what? Before tax. Or they provide you the cash flows relating to financing activities. You ignore those ones. You know why? You know, when we get the discount rate, we expect maybe, for example, this financial cost maybe to be included there already to have been reflected in that one. So including those ones, it could be like you are double counting, right? Let me tell you,
Okay.
discounting doesn't seem like minor something, right? But it is like that because if you discount something, its value falls down, right? So it's like you are deducting.
Yes.
So you avoid double counting. And the other thing now, let's speak of we have to speak of the cash flows, which are the future value, but also of the discount what rate. For the time it's easy. Someone pays 1 year, it's known. 2 years,
Okay.
it's known. Now we speak of the discount what? Discount rate. How should you compute?
Rate.
The discount rate used to calculate the value should reflect the time value of what? Money. Of course, in the exam, you'll be given this, right? Yes. And the risks
Okay.
specific to the asset, of course. But a lot of this one, if we need to go so deep into this one is done in financial management. But actually, for this case, it won't be a problem. They'll just provide it. So it should reflect the risk
Okay.
to the asset for which the future cash flow estimates have not been what? For which the future cash flow
Adjusted.
estimates have not been adjusted. You see that? You can see now. You see
Yes.
that I told you when you are. Let me. I want to remind you something. Do you remember when I was telling you about the exchange of assets? I told you to use the RAT, risk amount and what?
Yes. About right
Time. Yes. Do you remember
amount
for the
and time.
amount cash flow? This time, this was the cash discount rate. Do you see this risk? You can also see it here under discount rate. However, you can
Yes.
see how things are connected.
Yes. Yes.
Okay, so let's just go on. Now you're told here recognizing impairment losses in the financial what? Statement. How are you going to recognize the impairment loss? Okay, an impairment loss is just an expense, right? An
Okay.
impairment loss, let's say an asset had a carrying amount, like we said before, of 80, but also it had a recoverable amount of how much? We go to 70 in that assumption above. So if you have taken
Yes.
an asset at 80, but you can only recoup 70, you have to reduce the value of your asset by how much to get the impairment loss? 80 minus what? 80
By
minus
10.
70.
Minus 70.
Good. So if you do that and you come to the double entries, you know what you have to do. First of all, you look at the reality. My asset has fallen down by how much? By 10. The asset is
By
of a
10.
debit nature, and so I should do what? I should credit my what? My asset.
Credit
Let's say,
assets.
let me just write A. I would credit by 10, and so the remaining one would be the what? The debit. If you debit, we know that
Debit.
the normal debit is either an expense or not, or an asset, right? That's a debit nature. I told you assets and what? Expenses are of a debit nature.
And expenses.
expenses,
Okay.
because we obviously know that we do not have an asset here. So I would say this is what? It's an expense. So it's an expense, impairment loss,
Okay.
but is an expense in the statement of profit or what? Or loss. Then,
Loss.
so that's how we apply the what? The principles of that's how we account for the impairment loss, right?
Impairment.
So
Okay.
just say that it would reduce the carrying amount of an asset, and while it would be taken to the income statement, is what? Is an expense. Just like that.
Expense.
Okay. Now, let me tell you one thing. What if you are doing this for the assets under evaluation model? Right. I thought that you would see something
Yes.
now. Yes, we have learned about evaluation. For assets under evaluation model, you can just take this presumption. Always consider impairment loss as the revaluation what? Loss. I hope you do remember about the revaluation what? Revaluation losses. Right.
Module.
Yes.
Yes.
So
Yes.
we say that revaluation loss goes to profit or what? Or loss. Right.
Or loss.
Unless it is
Yes.
reversing the previous revaluation again, which went to all other comprehensive what? Income. So if you have
Income.
an asset, if you have an asset measured under revaluation model and it is undergoing impairment, this is what you do. In case maybe that asset of yours previously had a revaluation gain of 10, right? Or maybe a revaluation gain, let's say of 15, I'm presuming now. It had a revaluation gain of 15, which went to other comprehensive income, right? When you have the impairment loss of 10, you treat it as if it is a revaluation loss. You get it? So it's simple. So this impairment loss, instead of going to it will go to the income statement obviously with a debit of 10, but what I'm trying to say is, oh, let's say maybe this was just 8. The previous revaluation gain was how much? Was 8. So this impairment loss should
8.
go where the revaluation gain went. So since the revaluation gain in this case would definitely have gone to what? To other comprehensive income, we would also take our impairment loss to other comprehensive what? Income. Just like revaluation loss. So say other comprehensive income, how much? 8, right? And the
Yes.
remaining figure, the excess of 2 would now go to the profit or what? Or loss. So you simply treat
Or
it
loss.
as if it's the revaluation loss. Just get that point, right? Okay, so reading these ones now, this is what you see. I hope we just need to consolidate the knowledge here. We are told, hello?
Yes, sir.
Okay,
Now I can hear you.
if the asset has previously been revalued, if you speak of revalued, it means the asset is under revaluation model. In case it is on the other cost model, you wouldn't even need to worry about this, right? Because there wouldn't be this revaluation. So the impairment is recognized as a component of other comprehensive income, just like you do for the revaluation what? Loss when reversing the previous gain. And is debited to revaluation what? Reserve. I told you, I think you do remember. I told you whatever issue concerning revaluation that goes to other comprehensive income, it should go to revaluation what? Surplus. Revaluation surplus and the revaluation reserve are the terms used interchangeably, although I like to use the term revaluation what? Surplus. It's more common, right? Hello?
Sir?
Hello. Okay, okay,
Yes,
okay.
I can hear you. Yes.
So I hope you have got what I wanted to say. The remainder of the
Okay.
statement. So that's what we do. We do like that. Okay, let's go on now. Indicators of impairment. Now, if you do remember, yesterday when we studied about intangible assets, I told you that for intangible assets of indefinite useful life, you should always test it for impairment. Remember, testing for impairment is not easy. You need to get those cash flows for each year to estimate the cash flows and the ultimate figure for disposal to get the discount rate to discount. It's not easy. If you're just given the figure, it looks very easy, but it's actually tough, right? That's why when you actually deal with
Yes.
the fixed impairment, you first need to check whether there are indicators indicators of impairment or not. If there are no indicators, you do not need to go through all that hassle of getting those values, right? So those cash flows, those discount rates,
Okay.
you won't do that. But in case maybe you have assets of intangible assets with indefinite life, something with indefinite life, let's say, you have no way, for intangible assets, like I told you yesterday, you have no way of changing that value. So it would look like, what is this? This figure remains constantly the same each year. Although, of course, I will be checking the useful life and what, but we say that you need to check to test it for impairment every year. But these are the actual principles now of voice that what? 36. That is just an exception. 36 requires that at each reporting date, an entity must assess whether there are indicators of what? Impairment. So before actually testing for impairment is different to indicators of impairment, not that one. Sometimes if you are just new, you could think it's the same thing. I'm repeating again.
Yes.
You check for indicators of
Yes.
impairment, and when you find the indicators, it's when you test whether there is an actual impairment or not. Right? There are two different things. Okay. So indicators actually, it could be external indicators, which means indicators maybe by looking at factors outside the entity, but also you could look at factors inside the what? The entity. For example, here for factors, and let me tell you one thing about
Okay.
these matters. I think I already told you that to know whether there's an impairment or not, you compare the carrying amount against the recoverable amount. And by now, you actually know how to get the recoverable amount, right? You say that you have to take the recoverable
Yes.
what? Recoverable cost to sell, or the recoverable, or the value not in use. And you know what the value in use
In
entails.
use.
It has the cash flows, right?
Yes.
It has the discount rates, it has the time. So you can just write whatever you wish as long as you mention these factors. Yeah, right. You need to know how to use what
Yes.
you. So whatever we study here, we'll have to focus on this one. So whatever that shows that this
Okay.
value will go down, it means if the values go down, there is a risk that they will be lower than the carrying amount, right? And so there will be what? Impairment. You get the point there. So whatever factor
Yes.
that would make these values fall, you say, okay, that's good. For example, you are told the asset's market value has declined more than expected. Obviously, market value means the fair value has fallen. If it has fallen, it means this total figure would what? Would fall, right?
Oh,
So you can write
yes.
whatever you see based on this. Okay, here. Changes in the technological, market, economic, or legal environment have had an adverse effect on the what? On the entity. Maybe it's just maybe there are technological changes, for example, technological changes maybe which have had an adverse impact on the entity would actually make you as an entity maybe to get much less income, much less cash flow, right? Because of that problem. So if you do that, it means the cash
Yes.
flows would fall. If the cash flows fall, it means the value would what? Would also fall. So whatever
Okay.
makes this value fall, it would be an excuse. The other point, interest rates have increased and thus increasing the discount rate. Of course, when you see this discount rate, it is usually affected by the sources of finance. And we know the main sources of finance, the long-term ones, are the equity and the debt, right? Like
Okay.
debt produces interest while equity gives out what? Dividend. So if interest rates have increased, it means that the discount rate would also what? Increase. The cost of
Oh,
capital
increase.
would go up. If the cost of capital goes up, it means the discount rate would be higher. If you discount so much, your cash flows would be decreased much more than originally expected, right? So it would also be an increase.
Yes.
Then the entity's net assets are measured at more than market what? Capitalization.
Market capitalization.
This, this I think it makes a lot of sense. Our main focus is on assets as assets, but here they're speaking, net assets is like equity. So okay, in the books we have assets minus what? Liability. I hope you know about this, right?
Liability. Yes. Yes. To go to capital.
So you find out this one now. In our case here, we are only dealing with assets, right? But here they are taking it for all. When you speak of market capitalization, it's like you are going to the market and you do look at the value of equity as referred to the market, which we expect it to be the fair value of equity, right? So it's like you are comparing the
Yes.
fair value of equity to the book value of what? Of equity. This is the book what? Book value. Entities net assets, assets minus liabilities. So you see, okay, if you look at the equity in your books, the equity in your books is higher than the equity that the fair value of equity you find in the what? In the market. So you say, oh, what is this? Why is my equity that I hold in the books more than what I would have obtained from the market? Is there a problem? Are my assets having problems? Probably they have problems. But someone could argue that, okay, well, maybe my assets are fine. Maybe the issue is what my what? My liability, right? It's also possible. But it
Liability.
is an indicator that maybe the problem is on what? Assets, right?
Assets.
So this is another point here. Let's go to the internal sources now. We are dealing with the factors external to the entity. Now, there could also be reasons inside the entity itself which would indicate this. For example, there is an evidence of obsolescence or damage to the asset. This is obvious. If the asset is obsolete or there is a damage, it means it won't be able to obtain the cash flows it once was able to. Right. So obviously, an
Yes.
impairment changes in the way the asset is used have occurred or our timing. That is obvious. We have seen together that we could change the use of asset, right? Let's say you first maybe you could have an asset which actually maybe has this use and then you change the use of that asset. Okay, maybe let's say I had an equipment, right? I had an equipment, maybe I was using to produce myself, but maybe I change, I say, okay, and I say, okay, I'm no longer going to use this equipment to produce things for myself. I'm going to lease it out to someone else, right? And
Yes.
they'll be paying me. Maybe by doing that, actually, although you'll be receiving the funds without doing anything, but maybe you could be getting much less amount, right? And so we'd say, okay, this asset now it generates less amount than the origin. But also maybe another
Okay.
example, evidence is available from the internal reporting indicating that the economic performance of an asset is or will be worse than what expected. Of course, this is obvious.
Expected.
If you know the figure be worse than what is also fine, right? So the indicators will present them by themselves. If an indicator of impairment exists, then an impairment review must be performed. You see now, you can see just like the line items, but you really have to understand. I told you, indicators of impairment is what would make you to perform an impairment review or an impairment test. Impairment review, impairment what?
Yes.
Test. So know how to differentiate those two things and how to speak them in the exam when you are asked. Accounting treatment
Okay.
is very okay. Annual impairment reviews now. Annual impairment what? Reviews. You see,
Review.
usually we don't just do the reviews. We say that until there are indicators is when you do the what? The reviews. But this is an
Review or
exception
test.
now. You are told, okay, no way. We don't care about this one indicators. You have to do this each year, each financial what?
Okay.
Financial year. Okay. Usually we don't do that until there are indicators. But in case, let's say, we have an intangible asset, I'm starting with number two. An intangible asset is the indefinite useful life. We saw that yesterday.
I
Intangible
saw
asset.
it, yes, in intangible.
Yes.
And
Intangible with an
intangible asset, yes.
indefinite useful life. It means there is
Yes.
no way to reduce this amount, so you have to check for indicators of impairment. Not indicators, you have to perform the impairment test for impairment review each accounting period. Right. But also then
Yes.
an intangible asset not yet available for you. This to be
For
fine.
use.
I could give you an example yesterday. we are dealing with that question on intangible assets, and I told you we're dealing with the development cost. When you're still developing something, it means you'll just be accumulating the cost, accumulating, and accumulating. But even if it's not ready for use, at the end of each year, you should get the accumulated cost, which would cause the carrying amount. You compare the recoverable amount. If there is an impairment, you reduce it,
Amount.
right? Yes. So impairment doesn't need
Yes.
it doesn't need the asset to be ready for use. No, you can just impair it like that, right? And the other point is the goodwill acquired in a
Okay.
business combination. Okay, you're going to see this when you do the consolidation of financial statement. You cannot say that, goodwill is something that is very volatile, right? Due to its volatility, that's why you say that, okay, for goodwill in a business, and for goodwill in the business combination, you have to check for what? For impairment. And you would see that when you do apply this concept of business combinations, right, we won't be amortizing the goodwill. So you could find that, oh, this goodwill looks like you do not mention that it has an intangible, it has an indefinite life directly, but it won't be amortized. Not amortizing it means that we presume this, right? So these are the three main things
Okay.
that always know that you always have to perform impairment reviews with no regard to whether there are indicators or not. Okay, now Executive 6
Okay.
requires annual impairment review for those assets that you have seen. Now you're on reversal of impairment loss. Okay, reversal of impairment loss, it's no big deal. But I think before doing this one, you should look at an example. You can go through this one before. Okay, now, before going to the reversal of impairment, I think let's take our time and go on. This one. Okay, let's look at this example. Oh, what is this? Okay, let's start with the first question. The first question, the obvious one, but I just need to get something else here. We're just starting. The full information relates to three assets, A, B, and what? And C at the end of the
See.
period. We have assets here, asset A, asset B, and asset C. We have the carrying amount. We have the net realizable value.
Maybe you change the position. You are coming with cards.
Yeah. Okay. Hello?
You are coming with cards. Yes. Maybe you change the position. You are coming with cards.
Initially, I think it said the network was having problems. It said there were blips in internet connection. How about now?
Okay.
Is
Now
it
it's
better?
much better.
Okay. So let's proceed now.
No, it's much better now.
Okay, so we have the carrying amount, we have the net realizable value, and we have the value in what? Okay, this net realizable value means the fair value less cost to what?
In use.
To sell, yes, I've just put it. But the fair value less cost to what? Sell. Okay, what I would require to do, determine the impairment
Sales.
cost for each of the three assets. And pass necessary inventory to account for this. Okay. Can you help me with the impairment of asset A? First of all, we said we compare, we take the higher of net realizable of fair value cost and value use, right? You get the higher first, right? Because we say if you need to get something
Yes.
from the
Yes.
asset, if you sell it, you get 120 asset A. If you use it, you get 125. What choice you do, man?
I'll get 125 value in use.
So we have it here. Now, to get do we have impairment or
Yes.
not? You compare in the books, you have what? 100. But
No.
can remove this one. So impairment cost equals to what? To 0. There is nothing you can do there in the books, right? Because there is no what? Impairment.
Yes. There's
Okay.
no impairment.
So to asset B between 110 and 125, how much do we take?
125.
So we'll choose to use the asset instead of selling it. Okay. To compare that one, but in the book you have what?
Yes.
What are you going to do? Is there impairment?
Yes.
How much?
Here we do impairment because the amount in our books is higher than the value in use.
Okay,
It's
so
150,000 minus 125. It's 25,000.
okay, so this is okay. Okay, this is good. Okay, what we do would be the double entry. You know that our asset has fallen by how much? By 25. So am I going
By
to
25
so how to credit my asset? Asset what? Asset B, right? By what? 25. And then
asset.
I would
Yes,
debit the profit or loss,
by
right?
25.
Payment loss by 25. Good. So this is just like that. You can see how simple it is, right? And here, 180, you're going to take 100, which is higher. Okay,
Yes,
100 against 130. Impairment again of how much? Of 30, right?
it will be 30 of 30,000.
Yes. So
Yes,
you pass the entries as usual and everything gets done, right? Yes. So that's how we can see that impairment
yes.
doesn't have problems. Okay, now let's look at another question of ICCA June 2012. But A say the objective of a statistics is to do that and that. Required explain what is meant by impairment review, right? Your answer should include reference to assets that may form cash generating unit. Okay, wait, leave this alone. You are yet to start the cash generating what? Cash generating. So let that pass first. Okay, let's go to part B. Part B, what does it say? It's a lot of part B here. Okay, part B has included two different questions. Okay? Uh, we're going to do this by hand.
Let me ask you a question.
Hmm, I'm listening.
Um, how do you go? Yes, how do you go about it in the exam?
Hmm,
Whereas the information that you have been given in the question is a lot, it's
hmm,
not really short. Is it
hmm.
possible to start with the requirements, or you should go line by line and start
No, it's
calculating?
in an exam.
Because if you finish all of it, maybe you lose a
Yes,
yes.
you are right. In an exam, you better know what you have been asked, right? So that when you do,
Okay.
there are questions which are with the maths, and if you already know what you have been asked, you could actually be reading all of the question, but maybe what you are actually asked may be requiring to do parts. You just read the part and you have the what? You have the answer, right? If you read, if you read what you are required to do, it would be even easier to skim. You just skim that paper, chap chap, without reading word by word. And no, okay, they need this, so I'll find this
Okay.
information here and there and there, right? That's what we're going to do. You're going so
Okay.
in an
Okay.
exam, that's what in an exam, you should always come down here and read the requirement. That is obvious. Unless the question
The
is very short.
requirement.
If the question is short, it's no big deal. You can just read it, right? Unless
Okay. Okay, sir.
that is the case, you have to read. For example, here we are told calculate the carrying amount of the assets in Roman 1 and Roman 2 above at the
So
31st March 2012. We need the carrying amount
difference.
after applying any impairment losses. So the main aim here is to apply the impairment what? Losses. But sometimes it comes that there are questions which just at a glance you obviously know that what that information is there for, right? If you go
Okay.
by doing the question, okay, they are going to get this. But it's always essential to do that because you may find that maybe you even ask a normal question that doesn't even involve the calculation on part A, but you find yourself reading and reading and reading.
Yes, you are
Yes,
right.
yes. So yeah,
Yes.
after that you are told the calculations be to the nearest what? $1,000. Okay, it's fine. That's fine. So we are dealing with Roman 1 and Roman 2. As for Roman 2, I obviously see that we are not there yet. So we're going to deal with Roman 1. Okay. So we already know that we need to get the carrying amount, but it's all about impairment. So you know that when you do the impairment, you need three things: carrying amount, value, and fair value cost to sell. That's the essential point of reading the requirement. So you definitely know that, okay, I'm going here, but that is what I expect to find. But so we'll now read
Okay.
with a view to that, right? Saying internet connection and
Yes.
I don't know why. Okay. Telepath acquired an item of land at a cost of how much? $800,000 on 1st April
About
2010,
800,000.
right? 1st April
Yes.
2010, that
2010.
is used to produce and package pharmaceutical pills. Okay, that is the cost. 1st April 2010, the plant had an estimated residual value of 50,000. This is just normal information, and an estimated life of 5 years. I think at this point you know what we normally use this information for depreciation, right?
Yes.
But it will depend on the
Depreciation.
situation.
And
We have told you, and
the plant itself is it's a PPE.
good. Neither of which has changed. Okay, so until now, it hasn't what? Changed. So the residual value is still the same,
Change
and the user price is still the what? The same. We learned on
the
PPE
same.
what to do when the residual value and user price change, right? Okay. Telepath uses straight line
Yes.
depreciation. Even if they didn't tell you, that's the default, if no information. On 31st March 2012 now, on 31st March 2012, Telepath was informed by a major customer who buys products produced by the plant that it would no longer be placing orders with the Telepath. Hey, so the customer told him that it will no longer be placing orders with Telepath. So no, this is an indicator of impairment, right? If the customer is rejecting you, it
Yes.
means your plant won't be able to make the money it wants to
The
make.
value.
Yes. So it's already an indicator of what? Impairment. So in an exam, you mention that. You say, okay, if I want to do the impairment, this statement shows that there is an indicator of impairment, and so impairment review is necessary. If you mention that line of code in an exam, you're going to get the real marks. That's what I'm telling you. They don't
Okay.
look at just
Okay,
how
sir.
you solve. You need to show them that, okay, I'm doing impairment because I've seen this thing. You know, it's not like the first question. The first question was all about number crunch. Okay, we just look at this one, this is hard, and this one. But here, you look at the actual
Yes.
scenario. Yes. And so here, we're told it will no longer be. Then let's proceed. Even before this information was known, Telepath had been having difficulty finding work for this plan. The other reason, right?
Yes.
Yes.
Yes. Another
Even,
reason.
so it means even the alternative use was an issue apart from that one. Okay. It now estimates that net, the net cash inflows carried from the plant, right? Carried from the plant
Yes.
for the next 3 years will be what? It is
As
if
follows.
this guy is making noise. Hello?
Hello.
Okay.
Yes, sir.
Okay, so here we are told Telepath had been having difficulty finding work for this plant. Of course, it now establishes that estimates that sorry, net cash inflows earned from the plant for the next 3 years will be as follows, right? So on the first March
Yes.
2013, for the next 3 years, it means today is what? What date? If for the next 3 years, this is the first year, it means Now it is 1st April 2012, right? Am I right?
Yes, yes, sir.
Because this is 1st March 2013. So now, the moment we are speaking, it
Year
is
ended
1st April, right?
April.
2012.
Yes,
This is the important point you should know. 2012. You should also know what date the exam, the question needs you to deal with. If you come back here, let's just go back to the reminder. It says calculate the carrying amount for 31st March 2012. Okay, that's what they want.
oh,
31st March 2012. Okay, so it's the same date like this one, right? Because 31st March 2012,
yes,
we are
the
just
first
beyond,
one.
yes. At the end of the March, the
Yes,
beginning of this one. So it's just around here. Okay. Okay, that's good now. So you know
yes,
a point of reference. So speaking of this information is on cash flows. It helps you to get the value news. I hope you know that now, right? The first you'll get this one,
yes,
second year this one, and the third year this one. Then on 31st March 2015 is at the end of this. The plant is still expected to be sold with estimated realizable what? Value. Okay, the realizable value is how
value.
much? We are given it about up above there, right? We are told it was 50. So we still expect to sell it what? At 50 at the date of
50.
this 20. So after this one, it means you have 170. This comes from the cash flow, cash inflow just by operating, right? But now we are
Yeah.
also going to get the extra 50. So I would have 170 plus out plus extra 50 at the end of the last year, right? So I would have 170 and one what? And what? Which gives me a total of 220. A total of how much? Of 220. So we have the information for value news, but we would also need the discount rate there, right?
Where is the 50 coming from?
Listen, if let's say you have a vehicle, you're operating it, just from operations, you expect to get 10 million the first year, 10 million the second year, and the third year 10 million. But after getting these ones, you say that okay, I'm tired of using this asset, I'm disposing it. So you get its realizable value, right? I've earned it just by operating in the business, but now I say, okay, I need to sell it. I no longer need it, right? So let's say you sell it for 20.
Yes,
Yes. So if you sell it for 20, you get 30. That's what I'm speaking about. So this was the case too here. You're told from 31st March 2015, the plant is still expected to be sold for it's still expected to be sold for its estimated realizable value, right? So we still expect to sell it by that
yes,
amount. So that is also part of the cash flow we are going to get. And that's why when you read about the value news, you are told that you take the present value of the cash flows you expect to get from that asset by using it, but also its ultimate disposal. Right? I'm repeating again. It is specifically said that and its ultimate what? Disposal. This is what is its ultimate disposal. You do dispose it, you also get the cash flows. You got the point. Let me take you back. Let me take you back again. Yeah, come back and read the value news. Look at the value news. Do you see this one? It is determined by estimating the future cash inflows and outflows to be derived from the use of the asset and its ultimate what? Hello?
disposal.
Disposal. So if ultimate disposal is what we
Disposal.
actually get. We don't only take the amount that you're going to get while operating, while doing the business, right? You're also going to take the amount which you obtain even by stopping business and selling that asset. So we combine them all, right? Okay, so
Okay.
here we are. So what we do remain with here is we need the discount rate. Now it depends. We are told here that telepathy's cost of capital is 10 power percent, and the following values should be used. Okay. Now some people confused about this. They're told the following values should be used. This is like, have you ever heard of the rate present value factor? Listen, look at here very carefully. If you want to get the present value, say it this way. Say present value of future value, or you can just say cash flow, right? Over 1
Yes.
plus R power n. You could say this instead of saying over, if you say cash flow times 1, because cash flow times 1 is still cash flow, right? Then you divide by 1 plus R power what? 1 plus R power what? Power n. You get the point. Now,
And
sometimes we have
yes.
an exam. If you take this figure 1 over R power 1 plus 1 over 1 plus R power n, you put here that 10% equals 0.1, and then you put the n here. If you put n equals to 1 and you put the R, you would get this figure, right? If you put the n equals to 2, you
Yes.
get this one, this figure. And they put n equals to 3, you would get this one,
Yes.
figure, you see. So be careful. Even here, they just made it easy for you. They shouldn't even provide this. If you're provided with the present value factor, it's simple. To get the present value, you just take your cash flow, then your cash what? Your cash flow, you multiply by the present value
Times
what? Present value factor. We call this PVF. Is it?
factor.
Yes, just a factor. Everything, all math have been done. You just need to multiply it by the future value. So what we mean is, if you have the future value
Okay.
and you multiply it with the present value factor, it means we take that cash flow from the future to now, to the current period, right? That's what we mean.
Yes.
So in this case, it will just be easy. So I think until that point, you could use that to get the value new. Getting the fair value cost to sell is just simple.
Yes.
And getting the carrying amount is also what? It's also simple. As long as you know that we are speaking of 31st March 2012, just like we said. Okay. So first, let's get the carrying amount. The cost was first April on 1st April 2010.
Okay.
So 31st March 2011, the first year. 31st March 2012, the second year. So it's like 2 years, right? So we need to get the depreciation, the accumulated depreciation for 2 years, and then deduct it from our cost to get the carrying amount. Am I right?
Yes.
Okay, so let's get the depreciation. How much? We take the cost, 800,000, minus residual value is 50, divided by 5 years, right? Get the depreciation. Now let's go.
Yes. To be 300,000
Yeah, so 800,000, 150,
over 5.
get 150. Then you get the depreciation. Yeah, you get the accumulated depreciation which that day. Then you would have to deduct to get the carrying amount at that day, right? Cost minus accumulated what? Depreciation, and you would have a carrying amount. Very good. And then we usually compare carrying amount against the recoverable what? Amount. And like I told you before, for the recoverable amount, we take the higher of the value new of and the fair value cost to do what?
Yes.
To sell. Okay, how do you get the value new? That's what you have been explaining, right? You just take the present value of all cash flows. Year one did have how much? Year one, 220,000. Year two,
0.9. Yes.
I'm just writing the cash flows first. Then year three, it was 170. But I told
Okay.
you the cost of disposal is 50, so I added them. I told you 170 plus what? Plus 50. That's why you can see that there are four.
50.
Yes. And now instead of dividing by 1 plus first one over 1 plus R power n, 1 plus R power n, you avoid that, right? I told you that if you already have the
Yes.
present value factors, just multiply. So this one will be for the first year, this one for the second year, this one for the third one, for the third year. So it's your choice. You could have added 170 to 50 first and then multiply them all by 0.71 and 75, right?
5. Okay.
Yes.
Okay.
So you would have ended up having this much figure, right? That is the present value of cash
Yes.
flow, right? Okay, now
Yes.
I think we can now judge and see what we can do, right? Now, we also had to compute the fair value less cost to do what? To sell, first to get the higher value, right? But in our case, we don't even
Yes.
get that higher value. You know why? Look, you can see. The impairment is only there if carrying amount exceeds the recoverable what? Amount, right?
amount.
And for the recoverable, you see,
Yes.
the value in use we have got it at 514, the value in use alone. It means that we are only going to discard it if the fair value cost to sell is more than this, because we will take the higher, right? But you see,
Yes.
this this lower figure itself is more than one than the carrying amount. So there is even no need of computing that fair value cost to sell, because if it is lower than this one, 514, it won't be useful. If it is higher, it is obvious, because this lower one is already greater than 500, right? So there is definitely no impairment here, right?
Yes. Yes.
That's why we say that at the first March 2012, the value used of the plant is 514, which is greater than its carrying amount of 500. So this means that the plant is not impaired, even without considering the value of fair value cost to do what? To sell.
To sell.
Yes, there is even
True.
no need of doing that, because we already have the figure that is high. We already have an evidence of recovering something higher than what is in the book. Right. In case maybe the value maybe it
Yes.
was 490,
Yes.
then we would have said, oh, we don't know. We don't know. It seems that there is an impairment, but let's maybe first check for the value for the fair value cost. Maybe it may be higher than 500. So that's what we do. I hope you have got the points on how to go about
Yes.
that. Okay. So I think we could go on. This is something that let's go and go back and do it and then you know you have done something good, you have produced something this much amount, it's really cool. I mean the
You
next
are
question.
sounding very low and cutting. Again, you've gone.
Okay, I was just it was like I was murmuring. I was murmuring. So
Oh, okay.
yes, yes. Okay. So now we
Yeah,
go on
okay.
reversal of an impairment what? An impairment loss. You have seen how impairment works. Now we go on reversal of impairment loss.
Yes.
Okay. The same way, since we say that if we cannot recover the value of the carrying amount, we drop the value of the asset. The same way, if we find out that the reasons which cause us to reduce the value of an asset have changed, then we have no way but to try our best to reinstate back the value of the asset. Right.
Well, that's it.
Yes. So that's why I said that the
Yes.
calculation of impairment loss is based on the predictions of what may happen in the future. Of course, it's a prediction, because look at value news. Value news is like you look. I expect to get this much amount in year one, this much amount in year two. You're not sure of that. It's just an estimation, but at least maybe
Yes.
if you speak of the fair value cost to sell, you could speak that it is more realistic, because it is about that. It's now. We do it now. But for value news, it's not very realistic. It's realistic because it's predictable in the future, but actually it's not absolute. There is no an absolute assurance that that's what is going to happen in the future. Right. So impaired assets.
Yes.
Now, whenever you have impaired the asset, whenever you have impaired the asset, should be reviewed at each reporting date. You look now, we said you look for the conditions first, right? But here you can see the impaired assets should be reviewed at each reporting date to see whether there are indicators that the impairment has what? Has reversed, right? So you should always check, oh,
Best.
have these
Yes.
are there indications that that impairment has reversed or not? We check for that. And now reverse of impairment, we reverse it. Initially, the impairment loss went as an expense in the income statement, right? And if you do reverse the impairment, that means it will go as income, because it is going to be
Yes.
recognized, right? So it will immediately go as income in the income statement, right? Now, if the original impairment was charged against the revaluation surplus, that's what I was telling you, right? Now, presume this now. You get my point? Presume this happened, right? Initially, you were holding
Yes.
an asset under revaluation model, like we studied in GP. It Third, there was a revaluation gain. And then the asset was
Yes.
impaired. When it was impaired, instead of taking impairment loss to the profit or loss, you wanted to reverse the previous gain, and so you took it to other comprehensive what? Income, right? So now
Income.
that's what we are saying. If the original impairment was charged against the revaluation what? Surplus, we are told it is recognized as other comprehensive income. So this is what we do now. If the impairment went to the income to other comprehensive income, even this impairment reserve, which is an income, instead of going to profit or loss, it would also go to what? To other comprehensive what? Other comprehensive income, right? I hope you have seen that.
Income.
Yes.
Yes.
Credited to revaluation reserve. You know, revaluation reserve, you may reduce it or increase it, but this is obvious. If it is an income, it means when it goes to revaluation reserve, it would increase the revaluation reserve. If it was a loss, it means it would reduce the revaluation reserve. That's obvious, right? Okay. Now there is
So
a
it will be vice versa
yes,
when
yes,
reversing.
yes. Now there is a cap. There is a what? There is a cap. There is something we should not exceed now. This too is very, very important. You know, you first brought down the value of the asset, but then things have reversed. You want to take it up. Then, should you take it up with matches which or there is a cap? We definitely put a what? A cap. The reversal must not take the value of an asset above its depreciated historical what?
Course.
You should not exceed this, and it makes a lot of sense. You should not exceed the depreciated historical cost. And I'm repeating again, this is very, very essential. Because previously an impairment happened, you did it, and now you are reversing it, but you might find yourself, we presume that what if impairment had never happened, right? What would have been the case if I had the depreciated historical cost? You know the meaning of depreciated historical
Course.
cost. You presume that we bought an asset at 800, for example, that asset of ours, that, that previous example. We had this asset at a cost of
Yes.
800,000, right? We presume that in case there was
Yes.
no any impairment and it has stayed for 3 hours, for 3 years maybe, what would be the carrying amount? And that becomes your case, right? So whenever you see that revision
Yes.
wants to exceed that figure, then we say, oh no, this is the end, right? You cannot go beyond this. So whatever is less than that, you say fine. But whenever you want to exceed, you take it as the one, as the ultimate figure. That's what we do. Right. That's why I say it is the
Mhm.
amount it would have been if the original impairment had not been recorded originally. And the depreciation that would have been charged in the meantime must be taken into account. Simply speaking, that's the meaning of saying depreciated historical cost. It means you say, okay, I bought this asset 5 years ago, right? At this much amount of it. Depreciate it for those 5 years and get the depreciated historical what? Historical cost. Just like that.
Course.
Yes. Okay, maybe there's another point here for goodwill. You know, goodwill has a lot. Goodwill is very volatile. Now, presume maybe you had maybe you had the asset and goodwill had been impaired. If goodwill had been impaired and then there is a reversal, we never do the reversals on what? On goodwill. You know why? Goodwill is very volatile,
Good
right?
one.
That's why you will come and later see that when you compute the
Okay.
impairment loss for a combination of assets, not a single asset like you are doing now, whenever an asset has been impaired, we usually go and take goodwill and impair it in full because goodwill is very easily lost. Trust of customers. Maybe customers trust you, but they hear that okay, your management
Okay.
is very corrupt. They will lose faith ultimately and very quickly, right? So in that case, you are told that if you find that these people are not fine, they are saying that my goodwill is volunteer, but I'm saying no, I still have the goodwill. Then someone tells you that okay, if you really still have the goodwill, that is a new goodwill. It is not the original one. That's why they come with the point that okay, whenever you do impair goodwill, you cannot reverse the impairment loss of what? Of goodwill, right? And that
Mm.
You feel that that goodwill still exists, that is the new goodwill you have generated. And we said, if now there's a new goodwill of generated, that is an internally generated what? Goodwill. And the internally generated goodwill are
Good one.
not recognized because it cannot be measured reliably as we saw on ICAG intangible assets. Right?
Oh, yes, yesterday. Yes.
And yeah, that's good. So these are just indicators of impairment reserve. If just like they said before, just reverse them, so it's not big deal. Right? For example, increase in the asset's market value. It means fair value has gone up. Fair value goes up, fair value cost to sell goes up, so it's a reverse. Favorable changes in the technological market or economic or legal environment is fine. Maybe the company has come up with a good technology to reduce a lot of cost, and so the cash flow will be much more cash flow mean a higher value news, right? A higher value news mean that
Yes.
it's an instead of impairment reversal. Fall in interest rate. Fall in interest rate, it means the discount rate or the cost of capital goes go down, right? If the discount rate goes down, it means
Yes.
the cash flows would be impacted little, right? Much less compared to when the interest rates were high. So that case here also would make the value news rise, and the rise in value news means the higher recoverable amount. The higher recoverable amount means that there's a reversal of what? Impairment. Okay, as for internal indicators, what are you going to do for internal indicators? Favorable changes in the use of an asset. This one knows for the company sees it itself by its own decisions, right? Favorable changes in the use of one asset. Like you said
Yes.
before, maybe you had a machine, maybe you are leasing it out to someone else, but you thought that okay, I'm getting much rich funds, let me take it and use it by myself, right? Maybe you could find that you're getting much,
Yes.
but also improvement of the asset's economic performance. Maybe you have improved the asset. Maybe it's a machine. Maybe its engine wasn't fine. You have improved it. You have made proper maintenance and repairs, and now the engine is full throttle, it's up and running on all cylinders. It's so fine. Right?
Yes.
Let's go that to define cash generating unit. No, you're not going to do cash generation. It's simple, but nothing. And it's the last point, but which helps me to the impairment reversal, impairment reversal. Okay, it's fine. Maybe let's just now I wonder. You know what? I wonder if I do read this question because after 3 minutes it's going to cancel. But I wanted us to end here, but the problem is you can't end here, right? You can't end here because uh, we have to do, you must do an example. You can't just say impairment reversal and not do it. If we do it now, it would matter a lot.
Okay.
Yes. So we have like, okay,
Okay.
let's act like reading the question. The question says LK purchased a non-current asset on 1st January 2022 at a cost of how much? 30 million, right?
8 million.
Okay. At that
Yes.
date, the asset had an estimated useful life of 10 years. It's fine. LK does not revalue this type of asset but account for it on the basis of depreciated historical cost. Fine. As at the 1st December
Okay.
23, the asset was subject to an impairment review and had a recoverable amount of 18 million. That was at the 1st December 23, which was 2 years later, right? And then
Yes.
you're told at the 1st December 26 now, the other 3 years later, the circumstances which caused the original impairment to be recognized have reversed and are no longer applicable. You see now, an impairment reversal with the result that the
Yes.
recoverable amount is now 40,000. You see, from 18 million to 40 million, right?
40.
Yes. What I will refer
Yes.
to now Explain with supporting computation the impact on the financial statements on the first on the pre-impairment review. Of course, when you do explain, you have to write by with words, but writing with words, you also need the numbers, right? So the entry still remains
Yes.
important. So you can even do it aside, or you may do it as an
Okay.
additional thing. But when you are told to explain, you have to write. But you can't write without solving. So you can say that you may solve somewhere, or maybe you may leave a space for explanation. Solve down and leave a space for explanations up. Yes. Kind of
Okay.
forming an appendix, yes, for reference. Okay, so first of all, I think
So in this case,
mhm.
in this case, because in the exams we will be given the Excel sheet and the Word. So what will happen, because you can't type in the Excel sheet if it's like explain the way this question is, and you can't do some of the questions in Word. So what will happen? Are you going to you explain, it's the same question, but you explain in Word?
So we are dealing with this question involving reversal of what? Reversal of impairment. That was our main goal. Reversal of what? Impairment. And the first
Impairment,
section explained how impairment happened, and then the second one showed us an indicator that the impairment was what? Was reversed. So like we
reverse.
said, at that look, we are told that it was purchased at this much amount. We have the useful life of 10 years, no residual value for presuming to be zero, right? Then we are told
Yes.
that the asset is not revalued, so we use the cost model. That's what it means. And then at 31st December 2023, it's when the asset will subjected to impairment review and recover amount of this much. So let's get the carrying amount, because at any point at any point at which you perform impairment review, you have to compare the carrying amount against the recover of what amount. What was the carrying amount then?
Amount
What was the carrying amount?
18
18
million.
million. Carrying amount. Okay, you did compute it, or what did you do? Okay, so how do you get that? You take the cost, which is 30 million, right?
Sorry?
You get the cost, you get,
I I I thought
uh,
yes,
oh, it's 2 years. The whole of 22, because this is January, and the whole of 23, so it will be 2 years. So get depreciation for 1 year and then multiply it by 2 to get the accumulated depreciation.
yes,
Okay, so 30 million cost minus residual value is
yes,
million divided
yes,
by 10, it would be 3 million, right? After having 3 million, then you have 2 years. So you multiply by
yes.
2 years to get the total accumulated depreciation of 6 million. Then you deduct that value
6
from
million.
the cost to get the carrying amount of 24 what? Million. You have the carrying amount here.
24
Right?
million.
And now to know whether there's an impairment or not, you compare to the recoverable amount, which is how much? 18 million. Right?
18 million.
So you come and compare it, and you would obviously see that in the book I have more than what I can recover. So I really need to write down the value of my assets, right? So in this case,
Yes.
you would say that this asset should be written down. It should be credited by 6 million, while the corresponding figure should be debited in the income statement as an impairment loss. So you write the asset is written down to this one in the statement of financial position, and the impairment of this one is charged to profit or what? Or loss, right?
Or loss.
Of course, our focus is on impairment. The depreciation is charged per annum, of course, right? We could get it also, but no worry about it.
Yes.
Right now, we shouldn't worry about it. This is the first part. Let's go to the second. Now, it's the second part. It says on at 31st December 2026, impairment. There were indicators of what? Of impairment reversal, and we checked, and it was that this was 40 million as the recoverable amount, right? So,
Amount.
if
Yes.
you have done it there, we also need to get the carrying amount first. So, until at 31st December 23, 2 years have passed, but initially you had 10 years. So, you have remained with 7 what? 7 years, right? 7 years remaining, are
Yes.
you with what? Remaining with what? Life. 7 years, 8 years. Sorry, it was 10 years and 2 years had passed. So we have remained with 8 years. We had 10 years, right?
8.
Yes. So 8 years have remained, okay? So
Yes.
what we're going to do is, after writing down the value of the asset, it would now be 18 because we would reduce it by 60 million and then it would be what? How much? 18 million, right?
18 million.
So what will be the depreciation? I will take 18 million and a residual value which is not given, so presumed to be nil, divided by the remaining unit by which is how
Yes.
much? 18 over 8,
8.
get 9 over 4,
9 million.
and a quarter. 9 over 4, 2 and a quarter, so it's 2.25 million. Okay, this is the depreciation here. You can see 18 million over what? Over 8. We have this depreciation.
8.
How many
Okay.
years now? How many years? Remember, we are on the 5th December 2023. This is the point we are on. We are on.
Yes.
So we need to move from this point 3 years later. So our accumulated depreciation should be this depreciation per year, which was computed, times 3 years, which would give us 6.75 million. Which, if we deduct,
Yes.
we come up with a carrying amount of 11 million 0.25.
Yes.
Now we are in a pole position to compare the carrying amount of ours of 11.25 million to what? To the recoverable amount.
40 million. Recoverable amount.
So you obviously see, okay. My carrying amount was 11.25 million, but I can recover 40 million. Then if you ask yourself, okay, it's fine, I can recover the amount. Then am I going to recover to what amount? Am I going to, if I was told I can recover 100, would I need to recover everything? You know, if you speak of impairment reversal, you don't just need to speak of value restatement. You're not just restating the value. You need to reverse the impairment. So it should only be up to a certain extent, right? And that's why
Yes.
now I think this is the best way, right? You see, here you have the capacity to increase it to 40. So you compare, you have 40 million here, right? But you have to compare this 40 million against the amount that would have been in case we had never depreciated. I mean, in case we had never impaired the what? The asset, right?
Yes.
Yes. So this is what I'm going to do. We said that you look at how many years have passed since the use of the asset. Remember, at first we depreciated it by 2 years, and then second by how many years? By 3 years.
By 3.
So in total, we have depreciated the asset by 5 years. So we say, what was the original cost? Our original cost was how much?
18 million. 18 million.
It was
Oh, 30 million.
30 million. So you take 30 million, you ask yourself, what would have been had there been no impairment from the first place? What would have been my depreciated historical cost, right? So you depreciate the 30
Okay.
million over 5 years, right? I think it's 5 years, right?
Yes.
Initially we had 2 years, and
We
then
did 2 and
and
the
3, right?
next it was
So
3.
it's 5 years.
Yes.
So you need to get that one. So get depreciation per year, then you get it for 5 years, and then you get that, right? You can see, yes, this. I hope you can see this one now. So depreciation, you take 30 million divided by 10 to get depreciation per 1 year, times 5 years, which have actually elapsed, only to arrive at like
Yes.
how much?
15,000.
Then you deduct it from the
15 million.
what you remember, right? So you do compare. They say this is the simplest way. They speak a lot, but this is the simplest way, right? You just compare 40, which is the new recovery amount, and what? 15, right? You take the lower.
15 million.
We can only increase this carrying amount of ours up to the low of this one because 15 is the cap. We should not exceed this 15. So in case the recoverable, let's say it was 13, would have said, okay, raise it, increase it to what? To 13. But in case it exceeds 15, we can only go to this 15. So it's simply speaking, you increase this carrying amount to the lower of the new recoverable amount or the depreciated historical cost, whatever is the lower. It shouldn't exceed this 15, right? You get the point there?
Okay.
Yes. So,
Not really. I'm trying to understand you.
what we are doing here is if you do reverse the impairment and you just focus on the recoverable amount, you will find yourself reversing the impairment and recording something much more, which shouldn't have been recorded. Because I hope you know how to get the recoverable amount, right? Presume this thing.
Yes.
Presume this thing. Initially, the recoverable amount, maybe it fell by 20 million. And that's why maybe I had to undergo impairment. The asset had to undergo what? Impairment. But now the
Impairment.
value has increased by 50, while initially it dropped by 20. So if you're not careful and you go to that 50, you would find yourself reversing the impairment and doing something more. So you would end up calling the process impairment reverse while it's not impairment reverse. It's actually kind of any value restatement, right? And that's why we say, okay, the carrying amount was 11.25 million. Recoverable is 40, but you cannot increase up to 40. You have to increase it, but there is a limit. You increase it, but you should not increase it beyond 15. That's why you complete this 15. It should not be beyond what? 15. So in case the 40 million is not beyond 15, you increase it to that amount. In case it is lower than, in case it exceeds 15, you increase it to 15. It's just simple like that. Just increase this, but not necessarily to 40 million. You increase it to this 40 as long as this 40 does not exceed the depreciating historical cost of how much? Or 15 million. Oh, that's why I've given you a method to do this, right? Do this. Compare that 40 against the depreciated historical cost, which is how much? 15.
15.
Right? Take the lower. Which is the lower? 15, right?
15.
So increase
Yes.
11.25 to what? To 15. Done.
15.
So in case in terms
Okay.
of recovery amount, let's say was 13. It was how much? 13. Then you would still compare to how much?
13.
15. Which one would have been the lower? 13. Then we say, okay, it's fine. I can just increase this one.
13.
So to simplify matters for you, just
Okay.
take the lower of the two, right?
Yes.
So
Okay.
that means we would say, okay, our carrying amount was 11.25, but I'm going to increase it how much? To 15.
15.
Yes. So how are you going to do increase to 15? We would say it should be 15 minus the carrying amount, right? Which gives us 3.75. This one would be the reserve of impairment. And I hope we will know what we spoke about.
Huh? We are not adding it.
Yes, we are adding it. We first have to get it. We have to get it first. I don't know.
I thought we were supposed to add 15 million plus 11,250,000.
You add these two. How can you add the two? You cannot add this. Look. I think you overlooked something. Maybe. Look. You must have overlooked something. This is what I've said.
Okay.
This is what I've said. Initially, we reduce the value of the asset, right? But right now,
Yes.
we have the conditions which show us that we have to get to rise back the value of the asset. We do not add that. We do not add that figure. We add it up to that figure, not adding that figure, right? So this is what I would have done. I would have said, okay, my carrying amount is 11.25, but I can only recover it up to 40. It's not like I can add it 40. No, I can only increase it. Listen, when we are saying carrying amount is 10 and the recoverable is 6, we are not adding this one, right? We said, what should I do
Yes.
to make 10 6? We go to the impairment, and so you work your way to make sure that 10 equals what? To 6. That's why you go to the
To
impairment
6.
of 4 and then reduce the 10 by 4. You are doing the same here, right? You look, this is
Yes.
11.25. You want to take it to 40, but there is a condition. You compare 40 against what? 15, and you take the lower, right? So you see 15
15.
is the lower. So
Yes.
you do like how you did on impairment. On impairment, you are taking the difference. And here we are also taking the what? The difference.
The
Here we are saying
difference.
carrying amount is
Okay.
10. Recoverable is 6. Difference is 4. So reduce 10 by 4 to arrive at what? At 6. We do the same here.
Okay.
Carrying amount is 11.25. What we need is 15. What is the difference? Just like for impairment, exactly the same. 3.7 what?
Ah,
75. But
okay.
instead of deducting, we add because we are revising the what? The impairment price. Just like before. If
Then by
here
impairment.
we were affecting the carrying amount, but since it was higher, we were reducing it by the difference. Now we are also affecting the carrying amount as usual, right? But now instead of reducing,
Yes.
we are adding it by the difference. So it is exactly the same thing like how you deal with impairment. The only difference being
Okay.
instead of using the recoverable amount directly, you first compare it with the depreciated historical cost and use the lower amount, right? To get the figure
Okay.
which you
Okay.
get the difference. You got the point there now?
Yes. Yes.
Okay, so this difference of
Okay.
3.75 is what you are going to do. So you say, okay, I net my figure to be 15, but currently in my books I have 11.25, right? What am I going to do? I need
Yes.
to increase the value of my asset and I should debit my what? My asset. Let's I'm just writing
Asset.
it by 3.75, 75. And then on credit side, that's why I say impairment reserve is no longer an expense now. It goes as income. Income 3.1.75 again, right?
3.7.
5, right?
Yes.
So that's what you're going to do, and if you do that, everything gets fine, right? Uh, any question? Maybe any question?
Now I'm following. I've understood up to here.
That's why if I can tell you, initially we had the impairment of 6, but you are told it should be noted that the whole of 6 million original impairment cannot be reversed. The impairment can only be reversed to the maximum amount of depreciated historical cost based upon the original cost and the
Also.
estimated useful life of the asset. You should never exceed that, right? So that's just the case.
Okay.
Now we remain with one last thing. Okay, no worry. I think let's just proceed. Whenever it will stop, we'll finish up. We'll just finish. Oh, no problem. We are on the last part now. On the last part, something called cash generating unit. It's short, but I think maybe time won't be sufficient. Cash generating what? Unit.
Unit.
Why are we studying this? We also study this to get the impairment loss, but now it's different. You know, it's not like, if you do remember the way we were getting the recoverable amount, right? We are saying fair value less cost to sell or what? Or what? Value in what? Value in use, which required us to get the
Value.
cash flows generated by an asset, right? But now, look, first of all,
Yes.
if let me take an example on value in use. It's not like, it's not easy to consider each asset separately and determine the cash flows it may bring separately, right? When we speak of a particular asset and write the cash flows, it means those are the cash flows the asset can bring itself, itself as itself, judging it by itself, right? So that's tough. It's very tough
Yes.
to know the cash flows generated by an asset each at the end of each year, let's say for 3, 4 years, it's difficult. So sometimes we use something called a cash generating what unit. Cash generating unit, it is the smallest identifiable group of assets that generates cash flow inflows that are largely independent of cash inflows from other assets. This is what you try to do.
Assets.
Let's say you are a company, right? Then you say, okay, This asset cannot generate cash flows in itself. Let's say, for example, maybe you're dealing with the goodwill, it can generate cash flows by itself. So what are you going to do? We say, okay, let's try to find out the smallest possible group of assets that by itself, right, can generate its own cash flows, because to get the value you need to get the cash flows, right? So you take the assets in combination,
Yes.
and then you find out ways on how to break down that total impairment. If you find the assets in combination, you would get the impairment in total. And so you would have to find a way to divide that impairment, to spread that impairment to each asset independently, while you have that cash generating what? Unit. So that's the main aim of studying the cash generating what? Unit. It's because
Unit.
there are some assets for which you cannot determine impairment losses while they are separate, because you cannot get the values, you cannot get their accurate recoverable amount to deal with, right? Okay, so I hope you have got what we really intend here, right? So whatever you see, I don't know, when assessing the impairment of assets, it will not always be possible to base the impairment review or not on individual assets. It's difficult, of course. I have given you an example. So sometimes we usually based on a cash generating what? Cash generating.
Unit.
So cash generating unit. After getting it, you will find a way to break it down, right? And before exactly the same principle,
Okay.
like we say, whenever you do leave impairment, the carrying amount has to exceed the recoverable amount. Just this.
Exceeds the recoverable amount.
Okay. Then there are very few principles. You seem like tired. Okay.
No, sir.
You are good. Okay. If you are good, then it's fine. Now let's go
I'm
to the,
still okay. I'm still.
okay. So you're told, these are the principles. These very few principles. First of all, start with any specifically impaired assets first. Then impair the cash generating what? Unit. This is obvious, my friend, right? Presume that
Unit.
maybe you have like a combination of 5 assets and you need to know whether they are impaired or not, right? But maybe
Yes.
a certain disaster happened and one of those assets is totally destroyed. Are you going to determine impairment for an asset that is totally destroyed? No, it means it is wholly impaired, right? You definitely know, okay, this asset is
Yes.
totally impaired, or maybe I had 2 vehicles, one is totally impaired. So you know that you have to put the value of 0 that remains the carrying amount. That's why you're told start with any specifically. So if the question specifically is that okay, this asset was impaired by 40%, 50%, all of it was destroyed, it means it was fully impaired, right? Very obvious.
Yes.
Then I-36 Act requires that an impairment loss attributable to a CGU should be allocated to write down the assets in the following order. This is what we do now. After having done that, after writing down the specifically impaired assets, the assets which you won't even need to be asked, okay, how did you get the impairment? You just say, this asset was totally destroyed. What did you want me to do? It was totally impaired. We go to purchase what? Goodwill, right? So, like I told you before, goodwill
Okay.
is volatile. Whenever there is impairment, you cannot apportion impairment on goodwill like other assets. If goodwill is lost, it can be lost for good,
Yes.
just like its name, right? Goodwill can be lost for what?
Yes.
Good, yes. People may lose faith. It's part of faith, yes. So if people lose faith, that
Yeah.
faith is volatile. It is very volatile. You may
It'll
lose it
go.
once and for all, yes. Today it's very high, tomorrow it's 0. So if you have goodwill, also impair it in full. That's why it's people purchase what? Goodwill. Impaired in what? In full. Impair the goodwill in full. If there is still impairment to do, right, we presume that maybe the impairment is sufficient.
Yes.
Yes. I'm not saying that maybe the goodwill is worth 4 million and the impairment is only 3, then we say impair it in full. We cannot impair it in full. Why? There, it means impair it in full to the extent of the amount remaining, obviously, right? And then going
Okay.
on, we are told that the other assets, including other intangible assets, for example, in this issue, on a pro rata basis. On this pro rata basis, we mean you actually allocate the impairment based on their value. The asset with a much higher, with a higher value, it will get the higher what? Impairment. One is the lower value, it get the lower impairment. Just like that. But there is another point you have to note. Usually, especially for current assets, you would usually have the values or the actual values written here. No individual asset should be written down below its recoverable amount. This is obvious, we know it, right? You cannot say that I've done pro rata basis, but you find out that maybe the asset has been written down below its recoverable amount. And to avoid writing down an asset below its recoverable amount, right? I hope you know carrying amount, when carrying amount exceeds recoverable, we always write down the asset to their recoverable amount, right? And so to avoid making actually getting it down its recoverable amount, for most current assets are usually stated at their recoverable amount, and that's why for current assets we usually take their value as already as their recoverable amount, and that's why you say, meaning that unless specifically impaired, these current assets now are unlikely to be impaired as part of a part of a CGU because most of the time they are already likely to get their recoverable amount. You would see when you do this current assets, you take their figure at the year and then you put them there unless it's specifically told. So if the question is just silent on whether current assets have been impaired, you can just take their figure and put them there, right? So three things to match to net. Obvious impairment of assets, then you come to this current assets, put them to the recoverable amount, then there's this goodwill, and then the remaining assets is when you do them on a pro rata basis. I think let's just some point there. So it looks like you want to finish. I didn't expect this today. I was in a very tough situation. I didn't expect this. The issue is, when you do start, you find that some energy. I don't know, I've even it surprised me. I didn't expect to have the energy at all, but I wonder. Okay, now, if you do remember that question that we did, right? It had two parts. Part one, it did, and then it had part two, which we left. In part two, the requirement was calculate the carrying amount of the assets in Roman 1 and 2 above at 31st March 2012 after applying the impairment losses, right? Any impairment losses, a calculation should be to the nearest thousand. Of course, the first one was already in thousand, right? That's why it had nothing to do. And this one is also in thousand. Okay, let's read the question now. Telepath owns 100% subsidiary. It's very common, an example of a CQ for impairment purpose, we usually consider a subsidiary, the company you are going to acquire, or maybe the company you are controlling. You can presume it as a cash generating unit. It's common. So Telepath owns the 100% subsidiary. Tilda, that is treated as a cash generating unit. From the first March 2012, the date that the question has asked us, there was an industrial accident. You see, a gas explosion that caused damage to some of Tilda's plants. The assets of Tilda immediately before the accident were like this. So you see, this issue of industrial accident actually made the weight of the assets drop, so it is a great indicator of impairment, right? Okay, so before assets before the accident was followed. So what we had these assets, right? We had goodwill. So here we had the patent, intangible asset 2, factory building, corporate PPE, plant, PPE, and receivables, and what? And cash. These are the current assets. Okay. As a result of the accident, the recoverable amount of Tilda is what? 6.7 million. 6.7. It's like 6,700, right? Instead of what? 12,000. Now, the explosion destroyed to the point of no further use an item of plant that had a carrying amount of 500,000. You see, so on this plant here, 3,500, 500 has totally been impaired, so we don't need to ask. So we have to remove totally destroyed what? Assets. Right. Tilda had an open offer from the competitor for $1 million for its patent. So you have the patent, now you are told that the patent has a value of how much? 1 million more, right? You can recover it. Then the receivables and cash are already stated at their fair value, less cost to sell, which are their recoverable amount. That's why I told you for the current assets, they are already at their value, so you just write them when they are, right? Because you cannot write down the asset below its recoverable amount, right? So you can just go down here and see, you see, this is what we do. We just put our assets here, right? We just put the original cost, we copied them in the
Yes.
chart. So first of all, you write down the total, the obviously displayed assets. You see, goodwill wasn't touched, so you have left with everything. Patent wasn't touched, everything. Factor wasn't touched, everything. We are told part of the plant costing 500 was totally destroyed. So we have removed 500 from 3,500 and obtained 3,100. You see this? As I told you,
3,000.
we start
Yes.
with totally destroyed what? Asset. This asset was totally destroyed. Well,
Yes.
500, right? And then for the current assets, like I told you, you put them at their value, right? So after this, you get the net
Yes.
carrying amount of 11,500, and then it's when you prepare somewhere here for your carrying what amount and the impairment. Now, how do you get the impairment? You take the carrying amount, which is 11,500 minus the carrying. Sorry, what am I doing here? You take your carrying amount minus the recoverable amount to get the impairment, right? Hello?
Okay.
Yes, you can call this, if you can
Yes.
write off, you can call this recoverable, not to confuse the recoverable amount. So after doing that,
Amount.
yes, this minus this is when you get
And the other the 11,500 is the carrying amount.
yes, the carrying amount after reducing that 500. That's why it has reduced from 12,000 to 11,500, right? So we just restated the
Yes.
carrying
Okay.
amount. Yes. Okay. So we know the carrying amount after an explosion. Yeah, but just before testing the impairment. Okay, so we have this. So like I told you, the current assets have already been stated as their what and their figure. So that's why we copied this figure to here. The question told us. So it has an impairment of how much of nil, right? The other thing I told
Yes.
you, whenever there is an impairment and it is this big, goodwill was worth 1,800. So you impair it in full because it is very volatile. You can see we have removed all of it only to remain with a figure of how much here? Of zero, right? Have a figure of zero there. You see.
Sorry, sir. At the beginning, you said the goodwill cannot be impaired.
Goodwill cannot be impaired. I told you if you do impair the goodwill, you impair it in full because it is very volatile. The goodwill cannot be impaired. If the goodwill is impaired, I even told, wait, no, maybe you confused. I told you that the goodwill, the
Oh,
goodwill
cannot be
reversed.
reversed.
Yes,
Okay.
cannot be reversed.
Okay.
Yes, that's good. You know,
Oh, okay, but it can be impaired.
yes, it can very easily be impaired, very easily, right? So after doing this
Okay.
now,
Okay,
you
sir.
get the difference. 4,800 minus this 1,800 is like 3,000, eh? It's like I think it's
Yes.
like
Yes.
3,000, right?
2,000.
4,800
1,800.
minus this one, how much are you going to get? Also, okay, but also we had this patent.
3.
This patent, the figure was also given,
3,000.
yes, 3,000, but we also given the figure for patent. We are told that the patent we can recover 1 million, right? So you also
Yes.
for the patent, there is an impairment of 200. 1,200 minus 1,000, and you get this figure. So if you deduct this one minus 1,800 minus 200, you get 2,800. This one, right? 2,800 what? 100. You see this? So this
800.
impairment that remains is what we're going to distribute it between factory and what? And the plant, right? Break it down between the
Plant.
factory and the plant and everything will be fine. So it's just simple. You only have factory and plant. So you take their total. Factory has a weight of 4,000, right? And the plant 3,000. This is
Yes.
total of how much? 7,000. So it's just like you apportion them, right? So when you need the figure for the plant,
Yes.
you say, okay, plant was 3,000 divided by total, which is 7,000, right? Okay. When you go to the factory,
Yes.
factory is 4,000 divided by total, which is all what? 7,000. And then you must buy these figures.
7,000.
You must buy these figures by the remaining payment to be apportioned, which was 2,008 what? 100. So just do this here.
800.
To do it here, you would get this figure, right? 1,600, and here you get 12. So this is a bracket, it should be 1,200. So after having done that, you would have obtained your impairment losses, and so you can deduct to get your final figure here, right? 4,000 minus 1,600, you get 2,400, and 3,000 minus 1,200, you get this figure here. So you would have done your what? But don't worry, you are going to see the other ways of computing impairment loss of goods. Of course, it's not like I feed you per se, but you will see how we're going to do it. We're not going to do it this way, but we will see how to get the impairment loss of goodwill. When we are consolidating the financial what? The financial statements. I didn't expect this.
Okay.
I didn't expect to finish. This has surprised me. I just knew that, okay, I just took with that, okay, let's do something whenever you're going to earn